Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Izzet Bensusan, founder and CEO of Captona, Darpan Kapadia, Chief Operating Officer of LS Power, Gautam Bhandari, co-founder and managing partner of I2 Capital, and Charles Cherington, managing partner at Ara Partners. We're here to discuss where capital is flowing into energy projects amid a global infrastructure supercycle. It's great to have all of you with us. Welcome to Trade Talks. Charles, let's talk about investor appetite for renewable evolving in the U.S. What factors are driving this interest right now?
Sure. Well, obviously the residential tax credit's going away at the end of the year. That's going to have a significant impact on that sector. And I would say generally, even on a more commercial scale, solar investment is likely to slow down in the U.S. Tough to make returns, number one. Number two, some newly emergent regulatory hurdles that have presented themselves that make it a little tougher to get stuff built. In the long haul, there'll continue to be growth. It's a low cost source of power, and in a market where power demand is growing for the first time in years, that's going to be an essential part of the equation long term.
Yeah, and Gautam, I mean, I got that from you. You know, we're in the midst of a global infrastructure supercycle. What are some of the factors influencing that?
So look, I think a couple of things. One, huge technological change. So we are at the starting innings of AI, data centers, so huge power demand. There's a huge industrialization, reindustrialization of US happening. It's actually reindustrialization of West. Germany is reindustrializing, UK is, so that begets a massive infrastructure spend. And then you add to that infrastructure within the West is actually quite old. Yeah. It took me about 3 hours to get to this place from the airport, and it's just a testament to the sorry state of infrastructure we have. So, replacing old infrastructure, new technological changes, and the fact that governments are running record deficits. So that invites private capital. And so, these things come every 30 years because these infrastructure assets last a long time. And if you can get in at the ground level in one of these super cycles, you tend to do well.
Yeah, well, hopefully they'll start in the New York, New Jersey commuting region to test their projects here. Darpan, so it sounds to me that this is not a one-size-fits-all solution. It's going to take a number of different types of energy to execute on this.
Yeah, absolutely. Look, it's going to take a more of everything approach to get supply and demand to match. We're going to need more thermal generation and storage to provide firm capacity and reliability to the market. We're going to need more renewable power to provide low-cost, clean energy. We're going to need more transmission to connect it all. We're going to need more energy efficiency and demand response companies to help take the strain off the grid. So it's all the above, it's more of everything, and it's time to move forward.
Yeah, so what about solar in the US?
Well, I think solar is still the dominant play going forward, because if you think about it, we have gone from 18 gigawatts of solar in 2021, and now about close to 50 gigawatts a year being installed. And yet we're still at 58 cents per kilowatt, globally speaking, on average cost of power that we generate from solar, relative to China that's at 35 and Europe 44. So if you look at it, you see that solar will continue to dominate, and I think it's the most optimistic time ever you can invest in that source of energy, because there's nothing to build. Like if you build 50 gigawatts from solar, there's only capacity for like 3 gigawatts or maybe 4 from nat gas, and you have no other alternative. I mean, there's wind that can be up to 20 gigawatts a year, even less with the pushback. So when you look at solar, you say, well, I have room to lower the cost and room to grow very quickly. So I'm very optimistic about it, especially in this market.
Yeah. Well, I mean, Charles, I think a part of it too is that the economics have to make sense and it has to be available at scale. But there's also, we have to think about the intersection of energy security, which of course is a priority in the US. And then you also have decarbonization goals as well that need to be met.
Right. Well, I think when you look at decarbonization these days, it has to happen at cost parity or better. Right. So, and you've got to be able to make a return as an investor doing it. So in the kind of heady days of zero interest rates a few years ago, there were a lot of enormous decarbonization projects that were contemplated, started, and in many cases have just been catastrophic failures for investors. Going forward, you're going to see a much more pragmatic approach. So if you can't make money with a low carbon commodity, heads up against conventional sources, it's not going to happen. So I think there's a much more focused and pragmatic approach to decarbonization investing today versus several years ago.
Yeah, I mean, do you think it's going to have to be executed through public-private partnerships, or, I mean, you need the public part of it for scale, but you also need the money and the nimbleness that the private sector offers.
Private capital, for the reasons previously stated, are going to play an enormous role. Governments are stretched, number one. Number two, there is a massive amount of investment that has to happen. But we shouldn't underestimate how challenging it is to add new capacity. It takes years to build a new power plant. So one of the ways that you can decarbonize inexpensively is to look at existing sources of power, whether that's thermal or otherwise, and look at decarbonizing those in situ assets, which is much less expensive typically than building something de novo.
Yeah, and Gautam, when you're thinking about where the market opportunity is as it relates to the global infrastructure supercycle, what are some areas that look the most attractive?
Look, I mean, for us, we pursue the same thesis globally, right? So if you look at, young people, whether it's here or Indonesia or Japan, they have the same trends when it comes to digital infrastructure, same transportation themes. I think sometimes when you reindustrialize a society, simple things like transportation, we talked about the grid, so providing that last mile connectivity to the grid really helps. So we have a company that just does that. So you can play the same theme without actually just buying more NVIDIA, right? So you can actually get the same beta, but you can play the same trend, but not take the same risk as NVIDIA or the same beta. And I think that's what's fascinating. In addition to power, which is huge, this digital infrastructure, including at the edge, then there is good old transportation, the forgotten infrastructure that actually still is required to industrialize a society.
Yeah, well, how is this impacting M&A activity? Because we have seen, a handful of some pretty big deals announced.
Yeah, look, I think it's only going to increase. When you have these kinds of dramatic shifts in fundamentals, policy, and sentiment, you're going to see action. Things are going to move around. So companies are going to reposition, they're going to rethink their portfolios, and they're going to monetize what they can, raise capital to invest in different areas. Areas that were recently unpopular, like gas generation, is now popular. Flipped around the sentiment. Renewables were popular, now they're not popular. And so I think because of that change in sentiment and policy, capital is going to flow, transactions will get done.
Yeah, so is that, when you think about modernizing the grid fast enough, is it going to be able to keep pace with renewable growth, or will there be transmission constraints? How do you factor all this into the equation?
I think the grid is the last mile, as we all recognize it. You can keep putting power from every aspect of the grid, but it is the 111th year when actually the state regulation started for utilities to be a utility that's regulated, for a lack of a better word. And that actually started with Sam Ansel, is one of my favorite characters in history, who was mentored by Thomas Edison in New York and went to Chicago and started the grid as being a monopolized and fixed entity, if you want. I do believe that today, going forward, we are having a bunch of different things. The modernization is a word I would use, being able to unplug the cables and re-put them back in and put everything in, but that's not possible. Instead, what you're going to see, first already with the amount of batteries coming in, you do have a modernization of the grid to sustain peak demand. Let's not forget that the grid is suffering from peak demand issue, which is at least 40% of increase at just few moments in time. And then in addition to that, with the batteries coming in at large numbers, I think you are seeing the transition or modernization still happening, but the next level is going to be when you have changes in regulation on how a utility should operate, very much similar to the one we've seen with analog telephone lines into digital fiber cables. At least we have seen them.
Yeah, but Charles, we also have to think about the sustainability of these projects. Sustainable, I'm talking about in terms of their longevity and as well as their adaptability, because we do know that there is a shift in climate here, and it is impacting our infrastructure. So, Gautam had mentioned before, perhaps we get 30, 40 years out of something, but you also have to think about, okay, how do we get more? How does it adapt? Especially when you think about the technology that goes into it now.
Well, if we think about the grid, there are more than 3,000 utilities in the United States. It is a very, very antiquated system. To get a new power plant built, let's just take a natural gas plant, will take years. You've got to do grid studies, you've got to do re-engineering, there are all kinds of permits required, et cetera. So we are rapidly approaching, with all of the demand that comes not just from AI, but from data centers, from electrification of vehicles and other parts of the economy, a real squeeze on capacity. Solar can't fill it alone, even with batteries, particularly in northern latitudes or in places where it's more difficult to build. So you're going to see the owners of existing assets do very well. And I think you're going to see an enormous short squeeze on electricity. There just simply isn't the ability to build capacity fast enough to meet the demand that's out there. And it's going to result in a slow motion crisis in the US. There's just no way around it.
Yeah, which is interesting because these renewable energy conversations have been reinvigorated because of AI. I mean, AI is impacting everything over the past 2.5, 3 years, just because of the potential that it has and the demand that inevitably is going to follow.
Right, well, when you think about an AI company, is it a tech company or is it actually a utility fighting for capacity? Should it trade like a tech company or should it trade like a utility? I think the financial markets are trying to sort that out right now, but the amount of demand that these companies have simply can't be met with existing infrastructure, and building that next leg of capacity is going to take a lot longer and be a lot more difficult than people think.
I mean, you must have to factor in who's going to triage this energy as well, which I think is a concern, another conversation. But Gautam, when we think about going back to investing opportunities, how does one get access to that, right? It's one thing to get access to, into buying a share of NVIDIA. It's very different when you're looking at, infrastructure projects such as this.
Yeah, absolutely. And look, I mean, I'll tell you, within infrastructure, a vast majority of the assets are actually private. They're not actually publicly traded. So, and so you generally, no matter what you study, what time period you study, private infrastructure investments have, outperformed listed infrastructure. And so the way to access it till now has been very difficult. Now the rules have changed. So there are some 40 Act funds which allow ultra high net worth and accredited investors to actually buy into these semi-liquid vehicles. So that's one way to access it. I think the second thing I'd say, to Charles's comment, if you look at the innovation, what's going on to add this amount of grid, it's not like it's one big state player who's deciding this is the way it's going to move. It's a very distributed system. So tons of middle market companies, entrepreneurs, very innovative people who are looking for capital to deploy it in these very long-lived types of assets. And I think it's a historic opportunity. If you can get in at the ground level for assets that are going to last 20, 30 years, I mean, you have a very good compounding vehicle for yourself.
And also understanding what the time frame is.
Yes.
Right? I mean,
so look, I mean, so all these vehicles are available now. So the rules have already changed. So I understand 401k rules will come later. But I think for the first time, both not just institutional capital, but private capital is being mobilized to try and turn the tide of infrastructure, because I think governments all over the West, including US, have huge fiscal deficits.
Well, it's interesting, if you get that investor demand and there's more awareness to our infrastructure concerns and what it takes to build it out, perhaps that could be a catalyst to advance these conversations?
Yeah, look, I think there's a lot of capital that's needed in the marketplace. I think the supply point that was made is a very important one. We're a very good developer, and it's never taken longer to build large energy infrastructure in the US than it does today. If we wanted to build a gas plant truly starting from scratch, we wouldn't be energized for probably till end of 2030 or into 2031. So the supply side is going to be tight. The demand is real. We talked about the different forces there. So there's a really interesting opportunity during that time frame to buy existing assets, optimize those assets, expand those assets, perhaps even convert those assets into more efficient projects to meet the need. So we think the risk return opportunity around operating projects is exceptional right now when it comes to the generation side. And then the transmission side of the equation is particularly attractive, because if power is the bottleneck, transmission is the constraint. So there's the opportunity to develop new high voltage lines to connect firm capacity to load, to remove bottlenecks, to create more efficiency in the system, because we're going to have to get all these things right. So if the capital is available, and I think it is, because there's investor interest, there's a lot of ways to deploy that capital.
Yeah. Do you think we'll get progress as it relates to regulations and having some sort of a framework to be able to advance these projects? As you look, I mean, 2026, it's too late to think about 3-5 years out.
Yeah, look, I've been doing this for 18 years. And over the 18 years, what I've realized is every 2 years we have a new regulation. And it's not just federal, but it's also state, it's also city, less so. So I do believe that you will see changes based on demand, based on the location. Think about Uri, Hurricane Uri in 2021. It actually caused power prices to go to $9,000 per megawatt. And as a result of that, you had the beginning of the capacity markets in Texas, and it actually added up. I mean, they're trying to install 80 gigawatts of batteries. So my view is And I've seen this with solar. There was SREX, REX, all kinds of different tariff programs, whatever we want to call it. And in this case, I mean like feed-in tariff-like programs. But I do believe that the demand is there, and that's not going anywhere for the next 3 years, because it's very hard to project out. At least for the next 3 years, everybody is piling on more and more and more money and building data centers or any other infrastructure that is going to require the power. So you will see a lot of supply coming in, and where regulation doesn't help, it'll be the behind the meter, or it'll be mobile power plants. We've looked at all the solutions. So I think, yes, I mean, we do adapt very quickly in the US.
Yeah, well, I mean, who's going to wait 10 years, right, to build, another massive grid? I mean, just to getting the permits alone probably takes 75% of the project.
There's a solution around it, like we've been talking about, or internally we've been discussing. So these projects were inefficiently built in the past, and they become more efficient technologically, but they keep the interconnection to feed in the power. And you can repower so many different existing infrastructure. You can take ex-coal-fired power plants, put a solar there if you want, nat gas, whatever you want. And you can keep making them, add batteries, carbon capture storage, use the rivers for barges. There's so much existing infrastructure, like hydro too. You repower them, you just add on in the existing place. I believe you can add 25% more to the existing infrastructure without touching anything new. And you can do that in less than 24 months.
Wow. Charles, where are LPs directing capital within the broader energy transition, and how are fund managers adapting their strategies to the topics that we're discussing right here?
Sure. Well, if you think about headline deals like Northvolt in Europe, Stegra Green Steel, there have been headlines where billions of dollars were lost on big, risky bets to sort of build the decarbonization economy of tomorrow. That kind of sentiment is gone. I mean, first of all, interest rates are higher. Secondly, investors have learned a lot about those sorts of projects. So I think you're going to see a more pragmatic and incremental approach to decarbonization. So for instance, you can buy a natural gas power plant, you can put back-end capture on, and for these days, for about $120 a ton, you could decarbonize that plant if it's sitting on geological storage. That same site, built de novo, would cost multiples more than that. To put the equivalent amount of solar and batteries on that site would cost 5 times more than that. So I think what you'll see are the buying cash flowing assets, incremental decarbonization where it's possible, or if there are going to be new builds of anything, whether it's in energy infrastructure, it's going to have to be stuff that can compete heads up with conventional assets, full stop.
And that goes back to everyone's point here about focusing on existing infrastructure or not.
Correct.
I mean, I guess unless you think about it from a modular perspective and perhaps building something new from there, but it's really the existing.
Yeah, and mid-market, right? What's common in all these projects, Charles, that you quote is that they were one-of-a-kind, first-time attempt in the West to either make lithium batteries or to do clean steel. And I think those types of white elephant projects have unusual, like a huge amount of risk. And I think what developers in the US have done incredibly well is actually, frankly, the reposition assets or build smaller assets without taking that same degree of massive headline risk project. And I think that's where the market is headed. It's all headed towards mid-market infrastructure.
Yeah, I mean, you also need the skill set to be able to execute on these projects as well, which I think also lends to working with the existing infrastructure. There's a limited amount of skill set as well.
That's true. Look, I mean, I did my PhD in this country. My roommates were electrical engineers. None of them actually did electrical engineering. They're all working for Google and Microsoft, right? So there's an entire generation of electrical engineers that's actually missing. And so today, in our companies, we end up hiring retired engineers, people from transmission grid companies, and basically, talent is not available because US added very little demand to the grid for the last 25 years, right? We basically sent manufacturing to the east.
My father came out of retirement once for the exact reason. I mean, you need someone who's going to be able to execute on these plans, and I think it's something, as we look more holistically to advancing our infrastructure, you have to take that into consideration.
Yeah, absolutely. And look, I wouldn't put to the side building new infrastructure in the US altogether, because there is opportunity. We're going to have to do it. It's just going to take a little longer. It's going to be more expensive. We're going to need to get the labor to help execute, but we need to do it. So there's opportunities there. I think you just need to be selective. The bar has to be high because you're creating something new at today's construction costs, which are very high. And specifically around renewables, I think there's still an opportunity there to build new renewables, because once the tax credits phase out, any renewables that come in after that are just going to have a higher cost basis. So if you can build renewables today that are grandfathered or safe harbored under the current tax credit regime, they're going to have an innate cost advantage versus the next entrant. And that's going to be advantageous for that infrastructure.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks. And thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.